Hey yo, internet, what's up? It's Andrew, otherwise known as Drewicious. We're doing a video tonight about ER mechanics. Somebody asked a really good question today in one of the discords, and I thought that maybe I could, I don't know, doing it justice seems like a strong word, but I don't know, offer some insight, do some experiments, ask questions together. Let's go with that version of it. So tonight, guys, we are in the basement. Before you ask, it's not a do-rag or a skull cap. It is just a wool hat that keeps the head on my shoulders a little bit warmer. It is cold in my basement up here in Minnesota, and I have no hair under here. I'm not fooling anybody. I just gotta stay toasty. I got a glass of wine. I've cracked some Trader Joe's box wine. I think we're all set for a good evening of entertainment. So before we get going too far, I do need to ask you guys if this video helps you out a little bit. Be great if you could click the like button. Let the world know that I'm doing something worth paying attention to, you know, or don't. I know it's a lot of extra effort to tap the little thumb, but if you could, that'd be great. All right. So now that we have all of our administration out of the way, we're going to jump in. So here's kind of what I'm thinking for tonight, guys. I'm going to grab a couple of ERs from this past week. It is currently February 20th, 2023. So we had a bunch of big ERs last week. We're going to grab two examples, and we're going to look at a couple of different things about them. We're going to go look at the Greeks before and after the event, and we're going to keep track of the results as we go through it. We're going to use one of my favorite tools in Thinkorswim OnDemand to go back and find out how the market reacts when we do things. Some of these things I already have answers to, and some of them I don't. So we will very much be doing this on the fly together. So I'm just thinking of this as kind of like a lab experiment where we're going to discover some things together. I'm confident I will learn some things too while we're going through it. And somebody had asked a really good question today that I hadn't actually thought about before, so I'm curious to find out how that goes. All right, so let's flip over to the more advantageous view for you of this one. All right, so I got chaos going on in this chart. I don't want you guys to freak out. But there is something specific on here that I want to look at, and we're going to talk about as we get into it. So as I mentioned, we're going to be looking at two different tickers today. We're picking out two straight off of my watch list, and we're actually going to do, I'm going to do something here that I have not done before, but we're going to share this screen. This is, it's just Google Sheets, just a way for us to track our data. But I do have in the upper right-hand corner here, right below my face, is a snippet right from my weekly callouts last week. So 213, you can see on there that I had DVN and Datadog were two of the tickers that I had called out as potential interesting strangle candidates. So we're going to look at those two. I will tell you why I'm picking those two for our example here after we get into it, but for now, that's all you need to know. And then over here in the table side, I've got DVN and Datadog, and we're gonna do a couple of different little experiments here. So we are going to look at in the money strikes for a strangle and out the money strikes for a strangle. Those of you who have seen some of my other videos or have caught me in the Discords, you know that I'm a big fan of strangles for ERs where I'm expecting a large move. So we're going to, I've always played those out the money, but somebody asked about playing them in the money, so we're going to find out how that goes. I don't know, maybe it'll be amazing. Maybe it won't be my style, but it'll work out well for you, or maybe everybody will decide it's not their thing. I don't know. We're going to find out. But we're going to do in the money near, in the money far. So we're going to change in the money, out the money. And we are going to look at the current week and the next week out, right? So we're going to look at just a little bit. That'll give us a chance to dissect a little bit how the IV behaves with a little bit more time on the contract, what that does to the premium. So, and then we're going to look at some of the Greeks. I'm not going to record all the Greeks, but we'll look at them in real time here, sort of real time and on demand on Thinkorswim as we go through. So that is the plan for us today, guys. The reason I have this up, I'm going to talk you through here and don't like freak out. So we're looking at Datadog right now, and the reason I pulled this up is because one of the subcharts I have on here. This is just one of my charting profiles that I kind of play around with new indicators on, but there's one on here that I use quite regularly, and it's the implied volatility. which is a key metric when looking at option strikes, especially if you're looking at playing something coming up to an ER. Generally speaking, the implied volatility heading into a binary event like an ER is going to be on the ramp because we're expecting a big move. We just don't know which way, so the implied volatility gets higher as we get closer to that event. What we're doing, especially as we're looking to play strangles here, is we are looking to make sure that we take our entry when implied volatility is relatively low. So I've got this down here. This subchart right here, if you can't see it all that well, is the implied volatility. You can see it starts off here quite high at the start of Monday. So given that we're talking about last week, February 13th, this is that day, February 13th, and you can see that we come out of the gates as soon as market open. Implied volatility is very high, and but over the course of the day, you can see that it tapers off a little bit. So we're looking, and we're going to zoom in a little bit more here, but you can see as the implied volatility kind of tapers off, we do not want to grab our positions right at the open. That is, implied volatility, you can see, is at the highest part of the day. It will also get high at the end of the day. So somewhere in the middle, 90 to 120 minutes after open, generally an okay, safe spot. Also, if you are planning on playing a strangle, depending on what you see the chart doing, you can also do what I like to call wiggling into a chart, where you sort of, if we're relatively high for the day, you might look to buy your puts up here, and you might want to buy your calls down here. That will give you more advantageous pricing and potentially allow you to be green on both legs as you move in. And depending on your run up and how much time you have until expiry, you can actually ride the volatility up as we get closer and closer to expiration. We're going to see how that looks as we get into the Datadog ticker. So I'm going to pull up, we're going to start with DVN here. And we're looking at the same thing, right? So implied volatility, we're very much looking not to get. Now you can see with DVN that implied volatility did not change much throughout the week. It was really pretty consistent here. I take it as we zoom in a little bit, and I think part of this is actually OnDemand catching up with me. But you can see out of the open, implied volatility went up, and so we'd be looking to get down, 90 to 120 minutes in. You can see that it's relatively consistent throughout the day here. So it's not like we got as much as pronounced a dip in the IV as we did on Datadog. So DVN a little bit more consistent throughout the course of the day here. So we would be looking to take our puts and our calls somewhere in here. So let's go ahead and start talking about what strikes we might be interested in here. So if we go back and we take a look at my alert for the strangles here, I've done a post and videos on this before, but I have what I call strike zone. So whenever I go in and I look at the implied move for a given ER. The strike zone for me is generally the safe area. I'm looking to be about half of the implied move with the goal of ending up with one of my legs being in the money and green. And ideally over 100%. That means that my play is basically paid for, and anything over 100% is just pure profit. Right, because the winning leg pays for the losing leg at 100%. And then anything above and beyond that is just risk-free money, which I like, and so do you, by the way. So these are the risk zones that you can see over here. I don't know how clear it is on the screen that you're at, but for DVN, I call plus or minus $2. So that means that the safe strike zone for DVN is positive $2 from the current strike and negative $2 from the current strike. And for Datadog, it's $4. Same thing, 4 above, 4 below current strike. Now that current strike obviously changes throughout the course of the week. So there is definitely an art to looking at how to get into the best possible strikes. We're not going to be super careful about that here. We're just looking to grab some stuff and then see how the mechanics progress throughout the week. But I just do want to call out that strike zone, because you will see that on my alerts. In fact, I just posted my weekly alerts this week and have the strike zones out for some of the plays I'm looking at this week. All right, so back to Thinkorswim. So I'm not interested, as I mentioned earlier, I'm not interested in taking any options right at the open. I'm in Central Time Zone here, so the market's only been open for 5 minutes. We're going to go ahead and jump forward. Let's just go ahead out to like 10 o'clock. Let's give the market a little time to get going, and then we're going to take a look here at what happens to all of our options as we get into the middle of the day. So let's pop over here and have a look. Oh, there we go. So right there's our open. We're kind of midway through. You can see that our implied volatility, it did also kind of spike there at the open on Monday, and then we have fallen off a little bit. So this might have been a good spot here to get in. Our IV is creeping up just a little bit, but it's fine, especially for the purposes of our experiment here. So let's go back over. And as I mentioned, we're going to be doing in the money near and far and out the money near and far, right? So we're going to do we're going to grab a strangle on both of those, or we may just do a straddle just to keep things a little bit simpler. In fact, I think we will do a straddle to keep things simpler. Now I'm going to buy each of those legs independently. You can buy a straddle as a full instrument. I'm going to be doing each of my legs independently because I like to be able to exit each of the legs independently. All right, so as I mentioned, we have in DVN we have a $2 strike zone, so we're looking to go above and below about $2. So you can see our current mark, our last price is at $63.21. So I'm just going to kind of use loose math. It's okay. So I'm just going to say we're going to go for 61 and 65. That's what we're going for our. Oh, I'm sorry, we were going to do straddles here. So we're not going to worry about the strike zone. I take that back. I'm talking all over the place here. So we will just go ahead and do 63. We're going to do a call and a put this week and next week. So let's go ahead. We're going to go ahead and buy our call side here at 63. And we're just going to go ahead and add that in. Great. And then we're going to buy our put side as well. And then we're going to do the same thing, but a week out. So 63 calls, and you can see that the premium is not way higher. We're paying a slight increase. So we paid $1.96 or $196 on the 63 strikes for this week, and $2.30 for the next week out. So there's a little bit extra spend. And there will be less volatility. As you can see that the implied volatility is lower, and we do have some extra time. So we're kind of processing all this as we look at this, because in real time, I'm doing this with the benefit of kind of knowing what happens on this ticker. But I'm explaining what we're doing so that you guys can kind of process this as you come around if you're looking to play an options play like this at one of the upcoming releases. All right, so we're now in place. I'm going to come over here and mark down for DVN ITM near. We went with we're doing 63s all the way, so 63 call and put. 63. I'm going to say here that is the 217. 63 call put, and the 217, or I'm sorry, that is the 224. 63 call and put, and our premium for the near, let's see here, that was 196, and for the put it was 169. Okay. Oops. All right, so now we're in on those, and then for our FAR, that was, where is it, 230 and 201. All right, so those are our numbers for DVN. All right, we're going to go over to Datadog, we're going to do the same thing. Oh, wait a minute, we still need to do our in the money. So this is the part of the experiment I'm not so sure about. So in the money, and we're going to do kind of the inverse. So normally, if I were doing a strangle here, I would look to go out the money by a couple of dollars, right? So as I'd said, I would go to 65. So I think I did play the 65 and the 61. So here I would have gone 65, which would have brought our premium down to about 105. So it cuts our premium about half. Now, if we go in the money, our premium goes up, and our implied volatility in this case also goes up. And you can see that some of these other Greeks are doing different stuff. So the delta is, I mean, it describes a couple of different things, but ultimately the way that you can think about this is that it's the likelihood that you're going to end up in the money. And as you notice, the further out the money you get, the less likely you are to end up there, right? So, they're saying essentially you have an 11% chance of being in the money if you go 69, but you have a 90% chance of being in the money if you go with 58. And you can see clearly that they charge you a premium for a higher likelihood, which makes a ton of sense, right? So you get paid for the risk of being further out of the money, and you pay for the reduced risk to be in the money. So if we were going to play in the money here, and we're going to take a call at 61. We're going to try that one out. And a put at 65. And I think in this case we're going to go 66 just to balance out the way that the delta and the premium pricing there is working out. This is actually a better fit for the delta exposure. So we're going to go ahead and just take this because the premium is a little closer, even though some of the Greeks behave differently. And I'm going to run through the Greeks here just really quick in case you're not super familiar. So delta is essentially the percent chance that you have of moving in. It is also the amount of premium that you gain as you move forward into through the strike prices. Gamma is the amount that the delta accelerates with each move in the strike. So you can think of gamma as acceleration. So the move down here accelerates. So the gamma on the 69 strike is 4 cents. And that gets added to this. Now it gets rounded up into 16 cents. But then when you move up to the next strike, they add that gamma again. So they add 6 cents, which brings us to 21, right? So as you go up and you get closer to at the money, the gamma gets higher, which means that your move accelerates as you move towards in the money. That is why I typically play out the money, because I want to play that gamma ramp into at the money. And you notice up here, gamma does the exact opposite, moving away from in the money or at the money into the in the money strikes, right? So you go from $9, and each strike that you move, you're decreasing your acceleration, right? But again, you are also almost assured that your contract is going to expire with some value on it. Now, we're not usually playing these to expiry. We're typically just playing the premium and then getting out, right? But that's what's going on with these, and the gamma here does matter. And we'll talk about that a little bit later on, but it does play into the explosivity of the plays, or the explosiveness of the plays. I'm not sure which word is better for that. And then theta is your time decay, right? So it is how fast is your value decaying for the amount of time that you have it, and you can see that you are paying less further out. So the closer you are to in the money, the more you pay to sit on top of that contract. The further out you are, and you can see here this, I'm paying half as much for this down here. Now granted, my premium is less, my reward is less unless there's a big move. That's what we're looking for here. But as you get closer to the money, or at the money, that is where your theta is at its maximum value. Now compared to a week later, you can see that delta moves very similarly, right? These numbers are not drastically different, right? The strikes are the same. The deltas are very similar. Gamma is a little different. So we accelerate faster at the outer bands, but it flatten out a little bit in the middle here, right? So 5 cents is clearly bigger than 4, but 7 is smaller than 9, right? So we start a little higher at the outer edges, but we come into a little bit of a flatter peak at the middle there. And also you'll notice that our implied volume is lower. So that essentially means that we're blunting the effect of IV, which tends to be higher especially in the week of expiry of an ER. Now we're going to see that more pronounced in Datadog than we will in DVN. It was part of the reason that I was interested in this specific play. But the relatively low volume, relatively low implied volatility here was part of the attractive nature. I did play the expiration week. I think there is a case to be made, and we'll find out here as we take a look at what would happen. But DVN did continue selling off, and I actually got out earlier than I needed to. I was plenty happy with the result of my trade. I think my final runner I exited at like 750%, so I'm good. But there was more on there. I just wasn't interested in finding out. But buying some extra time might allow you to carry that over the weekend and find out if it continues to go down, right? It might not, but it could. Okay, so we are in our positions for DVN for both our in the money and out the money, and both our near and our far. So I think we're all set. Did I buy also? Let's do our in the money. Do our in the money on these as well. And that's 350 and 380. All right, we are all set on DVN. All right, we're gonna go take a look at Datadog now. All right, so let's talk about what we're noticing here in the Greeks. First thing that catches my attention is that the implied volatility is way higher, right? Before we were talking in the 50s and 60s. Here we're talking about 124. So we have a lot wider, oops, sorry there, microphone. We have a lot wider range where the potential move could go here, which means that our implied move is larger. So the implied volatility here is definitely something that could hurt us, right? And so if you've ever heard the phrase IV crush, it is essentially the idea that this implied volume is kind of artificially elevated right now because we're approaching that binary event, and it will come down after we find out what that is, right? It's after we know what's inside of the Christmas present, right? There's no more suspense, right? So that's kind of what that implied volatility is like. It's like the suspense of not knowing what's in the package. So as we look through again here, right, we have our delta very similar from week 1 to week 2. Our gamma very similar from week 1 to week 2. So, and you'll notice that this is essentially a very flat curve. Gamma doesn't change much on this one at all, right? So really all we get here is what, the delta, essentially the delta is moving in a very consistent manner from strike to strike. So we're going to do the same thing here. We're going to take, let's see here, 85. I think this was a $4 strike zone. Again, I'm not playing strangles, my standard strangle here. We're just going to do the straddle, which is the same strike price instead of a strangle, which is different strike prices. So we're going to go ahead here with, we're going to go with 83. So I'm taking 183 the week of, call. All right, there's that one. And we're going to do the same thing for the next week. All right, calls and puts on both sides. And then we are going to also do our in the money. So we did $4. So in this case, we're just going to say 80 and 86. How about that? So there's our in the money. And we're going to match up fairly well, 87. Again, in this case, I'm just making sure that the premiums match up. And then that was an 80, and finally an 87. All right, y'all, we are all set with all of our trades. Let's go take a look at all of our positions here. And there they are. There they all are, and we can take a look at our positions right here. So, and you can see it already knows that we've got some in the money. We've really not moved too much here, and what we're going to do is we're going to start advancing our charts in on demand, and we're going to find out how our contracts behave. All right, so coming over, Datadog, we're going to go ahead and just jump. Let's see here. Now I think the actual ERs for both of these guys were later in the week, so we're going to go ahead and just move forward to Valentine's Day. Move a day forward, take a look at how all of our premiums are doing. Delicious. All right, so here was our Monday. Now we're in Tuesday. We're kind of midday Tuesday, and we can maybe just kind of like see how things are going. Why don't we just go ahead to like towards the end of the day. Go see how things are going around 2 o'clock. So getting close to the end of the day here, we can see for Datadog anyway that we did get a push up. So we're up, and we kind of flatlined here towards the end of the day. So my guess is that our call leg is looking not too bad. Let's take a look at DVN, the chart itself. Now we got a pump there as well, and we a little bit rockier here, but we did end up kind of closer to the high at the end of the day. So my guess here is also that all of our calls are higher. Let's go take a look and find out if that's true. So here's our P&L. On the day and on the open are going to be about the same. So as expected, our puts are down, our calls are up. Overall, we're down at the moment. Now that is not unexpected on a week like this. Right, it's going to be a very volatile week. There's news happening all over the place. We're riding through other ERs. Now, sometimes what you can do is you can continue to average into your position so that you have a little bit more of a lot heading in. Now, if you're a newer trader or you don't have a huge account, I would not recommend that. Like, if you really want to play, I mean, look, if you're a newer trader and you don't have a huge account, I would not recommend playing ERs at all. I would recommend playing the reaction to ERs. Play sympathy tickers. These are very risky propositions. Now, the strangles and the straddles help diffuse some of that risk because we are playing essentially an omnidirectional play, right? I don't care if it goes up or it goes down. I can make money either way. I just have to make sure that it's a big move, or I have to hope that it's a big move, or I have to plan on it being a big move. Because if an ER comes out and nothing happens, you're going to burn on both of your legs, right? Both your calls and your puts can fry right in front of your face because of that IV crush. if you get a meh ER and it doesn't do anything. So we are very much looking for an overreaction. So a lot of times what I'm looking for emotional reactions or the anticipation or belief that there will be an emotional reaction in order to fire off algorithms in order to respond to the emotional reactors. We're also looking for triggering of stop losses, right? We're looking for things to help accelerate that move in order to hopefully trigger some sort of a squeeze event or a larger than expected move. All right, so day number 1, nothing terribly exciting happened. So let's go find out what happens on day number 2. And we're going to go ahead and just, we're going to see what the charts do. Okay, so yeah, big change out here. So it looks like we did have our event finally on Devon here. So we will definitely check in and see how our tickers are doing. But we had a very pronounced sell-off here, right? So there was the ER and it just tanked. I was very happy. And if you take a look, notice what happened to the IV, guys, right? So all the way up to that event, IV is very high. Event happens, it's frozen overnight, and we open, and then IV deflates, right? So that's that IV that crushes, and it's why you can be right on a call or a put. You can be right on your directional bet and still lose money because that IV is going to deflate and it is going to take the premium with it. So you have to be very in the money in order for your plays to work out. All right, so it looks to me, based on this, like we should expect our puts on Devon to look pretty good. We're going to go over and take a look here to find out which puts look best. And then our other one we're going to look at is Datadog, and I don't know, we have not had our event yet, so but we are continuing to push up. So my guess is that our calls are looking pretty good. I think our ER is technically tomorrow, as far as on demand is concerned. So now because we bought back here, right? We bought kind of middle of this day, and you can see that we're quite a bit up. So it may be worth considering, if we think that we're up enough, just exiting the calls and taking our money. And so we'll take a look at that and we'll talk about it and we'll decide whether we're going to hold on to it or not and ride through the event. But in the meantime, let's go take a look and see how our contracts for DBN are doing. All right, so DBN looks like it did pretty good. So DBN, we made $733. So let's review all the contracts that we took. So we knew that our calls were toasted, so we lost pretty much all of our premium there. We're down to 40 cents, 25 cents, right? Not much left. So we lost all of our premium on our calls. We were okay with that, especially when we take a look at what happened to our puts. So we bought the 63 put and the 66 put, right? So that was our in the money and out the money, right? So 63 was our out the money, and let's see here, is that right? And then 66 was our in the money put. Wait, did I go? I might have bought those backwards. Double check here in a second. So we did pretty well on those between the two of them, 400, 900 and change there on those two contracts. Okay, so those panned out all right. Taking a look here at our the next week out, we did pretty good on those too. The 63 put netted only $20 less, and we have another week to play. So that's actually pretty interesting. I would have expected a more pronounced difference between the move there, but that's pretty good. And for our in the money, 495 and 522. So again, that extra week for a little bit extra money gave us a very similar move, and we've got more time, and we dealt with less of the IV. So this is the information that I want you, that I'm also adding to my risk-reward model here of, well, you can buy yourself some extra time. And the truth is, and I can say this with hindsight at this point, right? If you had held on to this thing for even longer, it just kept going, right? So if we were to hold on to these, now more than likely I'm gonna dump these things, right? I'm not interested in holding on to these forever. I think I held on to my final DVN put until the end of the week, and I think I got rid of it on Friday because I saw them continue to go down. But Friday was also expiry, so I was definitely not horsing around with that. Like, I was going to take my money and get out. So, but Datadog we still don't know much about. But for DVN, we learned some interesting stuff. So the in the money did just fine, and the near and the far performed fairly similarly. So I think that that's pretty notable. Overall, we netted, looks like we netted about $1,000 out of this play. Or, no, I'm sorry, we netted about $733 out of this play. Like, that's what we get to keep after we burned all of our calls to the ground. We still made $700. So this was a nice ER play. All right, now we got to go find out how Datadog did. So Datadog, how did you do for us? Well, hold on a second. I think we did talk about the fact that we were going to discuss how Datadog was looking, because we've had a nice run up on the call side here. So Datadog, we are currently profitable $274, and we have not gotten to the event yet. So this is going to depend pretty heavily on what kind of trader you are and what your risk to reward appetite is. If you did not look ahead at what Datadog's ER was like, if I were sitting here the day before ER looking at $274 free money, right? If I just close all these accounts out, I made $200. That's on one contract. Well, granted, 2 contracts because we're doing an experiment here, but like that's not bad, right? It's pretty risk-free money. So we could decide to close this out, keep our money, and not care. Now, if you bought a lot, by a lot I mean like a bunch, right, or more than one contract, you could close out some or most of your position and play on house money, right? So if you could close these out, 274 is enough for you to hold on to. Well, none of these contracts are going to fit into that, right? So either you're in or you're out. But if we'd have bought 5 contracts, right, this would be closer to what, $1,200, $1,300, $1,400. Well, we could cut everything except for one of each and find out how those go, right, and hope for a bigger move. So we are not going to do that. We're going to just go ahead and head into the event and see how things go. So Datadog, how did things go for us? And I'm going to change this out to noon the next day so we can kind of get the midday reaction on things. All right. Okay, there was our ER. We had a nice dump, and it looks like we're kind of dumping again. Now, what's interesting is we're sort of right in the same range as yesterday, except for IV has tanked. Remember, this is the one with the high IV. Let's go see how our contracts are looking. Oh, damn. We went from $280 in our pocket to down $2,100. All of our contracts are on fire over here. Hey, look at that. DVN's actually made us more money by just sitting here. Not bad, right? So Datadog did us dirty. It did exactly what we don't want a contract to do, or what we don't want an ER to do, which was basically nothing. It did nothing, and we got hammered. Let's go look at the Greeks on this thing. Oh man, remember when implied volatility was like 125? Well, now it's down at like 65. So that IV hurt us bad, and you can see it in our premiums here, right? Everything is down. So now you can see that we're not worthless yet, right? We can still close out of this. There's still money in here, and we can still leave with our shirt, or we can see what happens on Friday. Should we just keep going and see what happens on Friday? Why not? All right, we're going to go to the 17th and see what happens on the chart. Okay, so we had a longer sell-off here, and it looks like we are now. Remember, we bought back here, right? We bought right about here, just barely above. So we are now below where we entered, but we're quite far below this this pump up here. And my guess is, right, and you can see, look at this implied volatility. That is just a tanking, right? So this is what killed us. Let's go take a look if we got any salvation with any of our contracts over there. Nope, didn't get any better. So we have some contracts here that are almost worthless. We got some that are worth some money, right? Like this one actually made a couple bucks. We're $40 up on one contract and $67 up on the other one. And we could potentially, I mean, the next week is actually next week, so I don't know what Datadog is going to do, but I will tell you that I would consider this a failed trade. For me, when I see that we have opened up kind of in range, if we didn't have a substantial move, then I know I picked a ticker that I shouldn't have, because I'm looking for more of what DVN did, which was have a massive reaction and freak out. And look at that, we go to Friday, We're up to $2,300 on our trade for DVN, and we have another week to go on some of these contracts, so not bad. All right, guys. I think that kind of covers the majority of it. So again, pay attention to what the Greeks are. You know, there's some other stuff you can do in here. You know, if you're not real aware of like, and it's a little tough to do flow analysis per se in here, but you can do things like look at open volume and regular volume to find out where people are going in and out in a more live view here of Thinkorswim. There would be some statistics at the bottom of the trade window where we could actually look to find out, you know, what's our put call ratio, what's the sizzle like on the calls and the puts. We can look to find out whether people are buying at the ask or the bid. Right? There's clues and hints there that we can get a sense. But I will tell you, they can be misleading because based on that information and I'll tell you what I was looking at. Based on that information, I was actually bullish on DVN. I was expecting a beat, and I took lottos on the 70 based on what I saw in here, which was this right here. All of this open interest in the 70. I'm like, oh, somebody knows something. So I bought some 70s. And whatever, man, it was like 25 bucks. Not a big deal, right? Like it was money I was willing to set on fire, and if it turned into an amazing play, I would have definitely posted some screenshots because that would have been a huge play. But that's not what happened, right? So that went away, and I was strapped in with more of my put contracts, so it worked out just fine. But you can come in, you can look for some of these things to see if there's some hints here, right? But in this case, there was definitely more open interest and volume going on the call side up here. In retrospect, either people were incorrectly optimistic, or they were hedging themselves against a short position. And this was just insurance. That is really what the options is supposed to be for anyway. So somebody was apparently using options for what they were meant for. It's crazy talk. So you can also come in here and look for clues in this data as well. But it is not necessarily straightforward, and the information, as I am very clear with you, fooled me on DVN. But it's also the reason that I like the way that I play my ERs. Generally speaking, I try to be as risk neutral as possible. Again, Datadog proved that there is no such thing as no risk. We lost a lot of money on DVN. Thankfully, I think if we were to go back and look at Friday, I don't think we lost substantially more than we made on, on Datadog. I don't think we lost substantially more on Datadog than we made on DVN, which might call it a wash, in which case it was a lot of stress and to do for nothing. But I didn't actually end up playing Datadog. It was just one of the ones that was on my watch list, and thankfully I didn't. But I was watching it very closely, and then very happy that I didn't take that play. And I got washed out on Airbnb. It was the only ticker I played directionally last week, and I was very wrong. So just reminding me why this is my strategy for ERs. All right, guys. I think that is suitable for tonight. Appreciate you coming by to help. Appreciate you coming by to watch. I hope that it was helpful. Again, if you found this helpful, please click like. Let some people know. I will see you guys in the next video. And if you guys are looking for here, and I'll tell you what, before I go, just given the time of stuff, I will tell you I've already posted kind of what I'm looking at for the week for ERs, but I will talk to you real quick about them. So this week I am very interested in Etsy and Square, and I will be watching mRNA and BABA as well. I do have those strike prices posted in the Discord, on my Twitter at Drewicious, and also on StockTwits, also at Drewicious. So if you want to take a look at what those plays are, I've already gone through and calculated the implied moves. These are the safe strike zones for the plays that I'm interested in. I will almost certainly be taking position in Etsy and Square, and then I'm gonna decide this week what I think about mRNA and BABA. But I found attractive elements in all of those guys. I'm gonna probably do a little bit of flow analysis this week, and I will update if I find anything interesting. All right, everybody, that is all I got for you. Have a great night, day, whatever it is. Hope you have some Trader Joe's box wine where you're at so that you too can enjoy yourselves, and we will talk to you later. Cheers.